Hey everyone, this is Kirk here again from Option Alpha, and in this video we're going to walk through what a reverse stock split is and why it happens and what impact it has on the outstanding shares and the share price of the stock or ETF that you're trading. Now, reverse stock splits can happen for a multitude of reasons, but one of the main reasons that it would happen is to either increase the share price of the underlying asset or to reduce the float or outstanding shares in the market. Whatever the case, ultimately what happens is after a reverse split, there are less shares outstanding and the per share price is now higher. This is as opposed to a stock split, which is reducing the share price and increasing the number of shares outstanding. So in our example, we're going to walk through a 2-for-1 reverse split or a 4-for-1 reverse split. A lot of people might also say it's a 1-for-4 or 1-for-2, etc. But I like the idea of a 2-for-1. That's how I kind of think about it as a reverse split is you have 2 shares and now you have 1, you have 4 shares and now you have 1. This is what happens in the market. So let's assume for the sake of argument that the per share price of a stock you own right now is $100 per share. And this keeps the math really simple and really easy. And you own 20 shares outstanding at $1 per share. So your total investment in this company is $20. Really simple and easy. Now the company or ETF announces that it's going to go through a reverse stock split, where it's going to reduce the amount of shares outstanding by basically a factor of 4, in the sense that every 2 shares that you have now will be turned into 1 share of the stock in the future. And we will adjust the share price accordingly so that, again, there's no impact on the value of the company or its market cap. So in this case, what they're going to do is they're going to remove 10 shares from your account that you own. So you have 20 shares now. They're going to go in and after or on the split date, they're going to remove 10 shares from your account and you're going to be left with only 10 shares left. You had 20, now you're left with 10. It's reduced by a factor of 2. So pre-split, you had 20 shares and you owned each of those shares at $1 per share, which means your total investment in the company was $20. Now, once you actually go through the post-split, the value of the company or the value of your investment is not impacted by this at all. It's just a distribution of how it's laid out. So after the post-split, you now own 10 shares and the per share price of the company has to increase in order to compensate you for the reduction in the amount of shares that you own and to keep the market cap of the company the same. There should be no impact on the company for the actual split in that moment of time. And so now your 10 shares are actually worth $2 per share because they increase by a factor of 2 based on the split. And that means that your total investment in the company is still $20. Now, again, this makes a lot of logical sense when you walk through it. All that they're doing is reducing the shares outstanding and they're increasing the per share price so that your pre-split investment or value is the exact same as your post-split for that moment in time. Obviously, it can change after that and the stock can start trading, but it forces the share price to go higher and it forces the number of shares outstanding to be reduced. And that's the goal of doing the reverse stock split. In the other example, let's go through a 4-for-1 split, which is a little bit more complex than a simple 2-for-1. And sometimes you might see them really crazy, like a 10-for-1, 16-for-1, 20-for-1, 9-for-1. There's all kinds of ways that they can do it, but essentially it's all the same mechanics behind the plate. So when you go through a 4-for-1, now you had your 20 shares, and now they're going to reduce that by a factor of 4 so that every 4 shares that you have now is just left over with 1 share. So essentially what you do is you reduce the 20 shares outstanding to just 5 shares. So we take the 20 shares outstanding, divide it by the split factor of 4, and we're left with just 5 shares that are left over. Now the same math works out, just a little bit different. Before the pre-split, you had 20 shares at $1 per share. And that left you with a value of your position of $20. And after the split, you now have just 5 shares of stock that are left, but the value of that stock has gone up to a factor of 4. So now we've increased the per share price by the stock split factor, if you will, or the stock split ratio, and the value of your investment still stays the same at $20 per share. Now, this is obviously a little bit more aggressive. They took a lot more shares off of the market or out of the market the float or outstanding shares reduced by a factor of 4, and the share price increased a lot more than just a factor of 2. You saw the share price go up from 1 to 4. And this can, again, be a little bit confusing because if you see a stock trading post-split and they haven't done any adjustments to the charting or to the platform that you're looking at it, you could see the stock price go up dramatically after the reverse split is done, and it might lead you to believe that the stock is on a run or having a big move, but it's just purely an accounting change that happened on the back end with the ETF or the company. So as always, hopefully you guys enjoy this. If you have any questions or comments, please let us know, and until next time, happy trading.